Alright, so before we get into some specific example, Chapter 12 is about incremental analysis, and often management accountants will make decisions using incremental revenue, or otherwise known as cost-benefit analysis, before they make a specific decision. Some examples include if you want to accept an order at a special price, do you get the special sales price less any variable costs, less any lost sales because of the special order equals your incremental income. So if there's a positive incremental income, you would likely accept the order at the special price. Another example might be if you want to make or buy, and if you potentially would save on direct materials, maybe save on direct labor, the variable overhead, and you'll pay a purchasing price equals a net income increase or decrease. So if your net income goes up if you make or buy, you will obviously select that alternative over the other. The other situation might be where if you want to sell or process further, say inventory at hand, and you'll look at incremental revenue from processing further, less any incremental cost of processing those materials further, equals incremental profit or loss from processing further. And if you have incremental profit, it's obviously a better decision to process further. Another example might be where you want to replace equipment, and there's a cost of purchasing equipment. There might be incremental savings in variable costs. You might also have disposal value of the old machine, so you have an incremental profit or loss from replacing equipment. If it's an incremental profit, you should replace the equipment. And last examples where you may want to eliminate a segment of your product lines, and you look at the lost contribution margin of that segment plus any removable or saved fixed costs equals the incremental profit or loss from the eliminated segment. So those are some examples just to give you the background before we walk through some specific numerical situations. Alright, we have the situation where Baden produces a product with a unit variable cost of $100, sales price of $176. They have fixed manufacturing costs for $480,000 when 10,000 units were produced. The company has a one-time opportunity to sell an additional 1,000 units at $140 each in a foreign market, which will not affect its present sales. So in this case, we have, just to identify the various components, variable unit cost of $100, sales price in the Canadian market being $176. They have an option for 8,000 units at $140 in sales price. The additional revenue potential is $140,000, being the $140 sales price, less the opportunity cost times the number of units. The variable cost is $100,000, being $100 each times the 1,000 units. So they have an incremental income of $40,000. Alright, we have the situation with Martin Company. They incurred the following costs for 70,000 units. So we have 70,000 units. We have variable cost of $420, which is $6 per unit. We have fixed costs being $392,000 or $5.60 per unit. We have an opportunity for a special order from a foreign company for 3,000 units. We were told that we would require an additional spending of $6,300. So we have the additional spend for $6,300 for shipping. However, we need to add the variable cost for that special order. So if we take our per unit cost of $6 per unit times the 3,000 units, we have a variable cost of $18,000. Our total incremental cost then would be $6,300 plus the $18,000 for a total incremental cost of $24,300. If we take our $24,300 incremental cost divided by the number of units, we get a cost per unit of $8.10. So in this situation, for any sales price of $8.10 or higher, the company should make these units. Alright, we have this situation. Clement Inc. They incur the following costs, produce 10,000 units of a subcomponent. So we have 10,000 units. We have direct materials, which is $8,400, being 84 cents per unit. Direct labor, $11,250. Variable overhead, $12,260. Fixed overhead, $16,200. I'm going to delete that for a second. Alright, so our total per unit cost, including fixed overhead, is currently at $485. We're given a situation where an outside supplier might be able to produce it for $285 a unit, so $285 a unit. So our cost if we outsource for those 10,000 units of that subcomponent would be 28,500. Our savings if outsourced would be only the variable costs. So we have direct materials, direct labor, variable overhead. Our fixed overhead would still be incurred whether we produce the unit or not. So in this situation, I take the savings of outsourced being the per unit cost at 84 cents plus the $1.13 plus the $1.26. Multiply that by the 10,000 units, so we'd have a savings of $32,250. Our net savings in this situation then would be the $3,750. Alright, we have this situation where they have an organization that produces 100,000 units. They have variable costs of $600,000, $6 per unit, and fixed costs of $900,000 or $9 per unit. We have an offer to make from a supplier for $4.50 per unit, so multiplying that times the number of units, we have a total cost from the supplier of $450,000. The savings in our variable costs, we would save $600,000, our fixed costs would not change, but then we have the opportunity to lease for an additional income of $165,000. So our total net income would increase in this case by $315,000, which is option B. The next example, we have the manufacturing company that they can make 100 units of this necessary component with the following costs. Let's start our table. We have 100 units. We have $120,000 in direct materials, $25,000 in direct labor, $45,000 in variable overhead, $30,000 and fixed overhead, giving us per unit costs in total of being $2,200 per unit. If the item is outsourced, we're told that we would save, or the company would save $20,000. And obviously, if we're not producing, the direct material costs would be saved, the direct labor costs would be saved, and the variable overhead costs would be saved. So total cost saved if outsourced would be $210,000. Therefore, the difference between making or buying would be at that $210,000 threshold. So any price point below that, the organization should consider buying. Alright, we have this situation where Jansen Company has old inventory on hand that costs $24,000. Its scrap value is $32,000. It could be sold for $80,000 if it's manufactured further at an additional cost of $24,000. What should they do? So what we want to do in this situation is look at the incremental revenue. So we're told that they can make $80,000, and it would cost them $24,000 to manufacture that. So the income or profit from processing further would be an additional $56,000. Now it's important to note that the $56,000 is exceeding the scrap value of $32,000. Therefore, they should manufacture further and sell it for $80,000 because they'll make more in this situation than if they just sell it for scrap. Alright, we are given this company, Marcus, that they gather the following data about 3 different products it produces, A, B, and C, and we're asked to determine which products should not be processed further. So in all 3 situations, we want to look at incremental revenue over incremental costs. Product A had incremental revenue of $21,000, less the cost of $8,000, for an incremental profit or loss from processing further of $13,000. Their value today is $12,000. So in this case, if they can make more than the current value, they should continue processing. Okay. Next situation, we have product B is worth $18,000 if they were to process it further, less the $5,000 it'll cost to get there. Their value now is $14,000. They should not process this any further. It's worth more now today without any further investment. Product C is $16,000 in incremental revenue, less $3,000 in incremental costs, and their value, creating an incremental profit of $13,000 against a value now of $11,000, and therefore in this case it generates an additional $2,000 of profit. They should process that further. So to answer the question which should not be processed further, it would be product B, which is option B in this situation. Alright, so we have this situation where they're considering replacement of a piece of equipment and they're asked which data point is irrelevant to the decision. And I've actually populated on screens. The net book value of the old equipment plays into no consideration. It is an accounting process only, not a cash considerations. So let's walk this through as far as noting some additional analysis. So the net book value of the old equipment is currently $135,000, which is the $225 purchase price less the accumulated depreciation of $90,000. Other savings and costs, though, we look at the cost of purchasing a new equipment would cost us $375,000 if we replaced it today. Our total incremental savings and variable costs over the 5 years of both a piece of equipment's useful life would be $300,000. So it's a savings of $60,000 per year. $300,000 less the $240 times the 5 years would be an incremental savings and variable cost of $300,000. They would have a disposal value of the old machine today worth $60,000, creating an incremental profit or loss, in this case being a loss of $15,000. Therefore, the irrelevant amount is the net book value of the old equipment being $135,000. Another way to look at this scenario is if we just look at what the accounting income impact are, just to prove our incremental analysis, is under the current situation we have depreciation for the next 5 years of $135,000 because it would be fully depreciated. We'd have variable costs of $300,000 per year for 5 years of $1.5 million. So the total cost if we stay with the current machine would be $1.635 million. If we go with a new machine, fully depreciated in 5 years, would be the full cost of $375,000. Our variable costs are $240,000 per year times 5 years, giving us a total cost of $1.575 million, slightly less than the cost of the current. However, if we sold the old, we would A, get income of $60,000, but B, we would have a write-off of the old machine of $135,000. So our total cost, if we replace the equipment under the accounting lens, would be $1.65 million, less the cost of the current machine of $1.635, reconciles the fact that there'd be an incremental loss of $15,000 if we were to replace the unit now. Alright, we have a company that has 3 product lines, one of which reflects the following results. Sales $215, variable expenses $125, contribution margin of $90, less fixed expenses of $130. They have a net loss for this product line of $40,000. If this product line is eliminated, we're told that 60% of the fixed expenses can be eliminated and the other 40% will be allocated to other product lines. If they decide to eliminate this product line, what will happen to the net income? So we start with the contribution margin we would lose if we close up this line, so we'd have $90,000 lost. And the saved fixed cost, we're told to be $130,000 times only 60%, so 60%. So we'd save $78,000 the fixed cost. By eliminating this product line, it would actually create an incremental loss of $12,000. Therefore, it is option C, which is a decrease in net income of $12,000. Alright, we have this North division has the following information: sales, variable, and fixed expenses. And we're asked if this division is eliminated, the fixed expenses will be allocated to the company's other divisions, so there'll be no reduction of fixed expenses. So what's the incremental effect on net income if the division is dropped? In this case, we have a contribution margin that'll be lost, which will be losing those sales of $1.2 million. But then we need to also subtract the variable expenses of $640. So our contribution margin lost by dropping this would be $560,000. We're told that there is $0 in saved fixed cost. Therefore, we have an incremental loss from this eliminated product of $560,000. Therefore, it's a decrease, option C, of our net income. Alright, we have this company Sala. They're contemplating the replacement of an old machine with a new one, and we're given this bunch of information: the old machine, new machine, what the remaining useful life is, and the annual operating costs. So in this case, we're also told the old machine can be replaced for $24,000. We're asked to calculate the net advantage or disadvantage of buying this machine. So first of all, we have a cost of purchasing new equipment of $600,000. We have incremental savings, which is the difference of the variable costs. We need to add back the fact that the current machine is costing $240,000 a year, plus the $180,600 cost for the new machine, times the 10 years that the machine will be in operation. Then we also would add the fact that the old machine would be sold for $24,000. So this would give us an incremental profit from replacing the equipment of $18,000, which is option A. All right, so that ends some of the Chapter 12 walkthroughs, and as always, you can email me or contact me with any other questions you may have. Take care.